Peter Lynch is one of the best value investors ever, with a track record nearing almost 30% over a 14-year period. That track record tells us that this man knows how to pick stocks. He knows what trades make a good investment. And thankfully for us, he has written down those trades in this book, which is called One Up on Wall Street. Do you know what the most important trade of a good investment is according to Peter Lynch? Well, I quote, it sounds dull, or even better, ridiculous. Why is that? Well, if a stock sounds boring, not a lot of people will be researching said stock. And if there isn't a lot of competition, the stock will most likely be priced unfairly, either over or undervalued. But the point being, with less eyeballs, the chance of a mispriced security happening is higher. So, according to Peter Lynch, we should all be looking for stocks with boring AF names. Moreover, excellent trade number 2 for an excellent investment is: the company does something dull. And today I have found this boring company operating in an even more boring sector. Today we are looking at a company called Atkore, or ticker symbol ATKR, which is a company operating in the cable, conduit, framing and fitting industries. And I promise I'll try to keep you from falling asleep. So now let's start quickly with a company overview. So really, this is Atkore, a company which could have their products all around you without you knowing it. They do the entire electrical wiring shebang, from having their own cables, conduits, armored cables, metal conduits, fittings and wire trays, and really it goes on and on and on. And really, this is the only real reason why the business side of Atkore is interesting to me. They are the number 1, 2 or 3 based on market share in so many of these sub-industries. Atkore managed to achieve these impressive market shares by 2 main ways. First, by acquiring well-established companies and brands in these sub-industries, and second, by offering extremely competitive short order cycles and reliable service. So both through organic growth and non-organic growth, or mergers and acquisitions, or M&A. Of course, this boring ass company had to give us a boring ass pun, but these 2 factors I've just described, the company internally calls their conduits of growth. Atkore management, I hate you for this. Atkore has broken down those internal organic growth factors into 2 different categories. So first, new product innovation, and second, focused product categories. So the first one expands your market potential, and the second one can greatly increase customer experience. And of course, the third leg in this growth story is M&A, or mergers and acquisitions, which is of course non-organic growth. As a reference, in just the third quarter of this year, 2022, the company already acquired 2 new subsidiaries, which is quite the feat. Before we discuss the growth potential further, I first want to do a deep dive into the financials of this business. I got these numbers from a very reliable source called ROIC.ia, and I did check most of these figures, so they should be correct. But again, always do your own due diligence. However, what I want you to focus on is this. And these growth rates are just insane. With, for example, a 70% compounded growth rate in their EPS, or earnings per share, for a 5-year period already. And the revenue growth is also there, with a 30% compounded growth rate for that same 5-year period. Both are mind-boggling. So the company also did a lot of revenue growth, but the difference between these 2 numbers tells me a story. A story of the company continuously increasing their growth, but most importantly, net profit margins. You see, if their margins had remained flat, we would have seen 70% on both EPS and their revenue growth, but we aren't seeing that. Instead, we are seeing this picture, where the company increased their gross margins from 20% and net margins from 5%, all the way to 40% gross and 20% net. That is extraordinary. And thanks to economies of scope, the company will most likely continue to suppress their average cost per unit, therefore increasing their profit margins. You might not know what economies of scope are, so a quick explanation. Economies of scope are the cost benefit a company enjoys when their average cost per product goes down after owning a second or third or fourth, normally slightly related product line. Meaning average cost to go rup, which is the opposite from brrr, when a company starts producing a second product line. So what I am saying is Atkore is able to continuously increase their net income and gross profit margins because they are acquiring so many businesses. Atkore is basically the stock market equivalent of a pro-level agar.io player. They gobble up any good business they can find, and thanks to those acquisitions, they increasingly get stronger and stronger. So we are seeing insane growth on all the metrics I care about. The company is only carrying about $792 million of long-term debt, which it can pay off in less than 1 year of net income, and the company has really solid return on invested capital and return on equity figures. Moreover, the company is sitting on about $200 million in cash, has more current assets or liquid assets than their entire liability position, and well, balance sheet wise, the company is just in a really healthy position. The only thing that I would note is that their inventories are ballooning at a pretty quick pace. You see, significant increases in inventories can point towards a slowdown in business. Moreover, inventories can expire or become outdated when a new technology takes over. So point being, we do not want to see too much inventories on a balance sheet of a company. However, from the company's third quarter shareholders meeting, I have gathered that this increase in inventories comes from an increased value of said inventories. So that ballooning of the inventories on the balance sheet doesn't come from inventories sticking around for longer, and it doesn't come from a higher volume of inventories. According to the management team, this increase in inventories comes from a higher value of inventories, which isn't necessarily a bad thing. So like I said, a really healthy company financials wise, but there are two more topics we should discuss before I can give you my juicy valuation. First, guidance. The company is actually guiding for a lower profit in 2023 than they are guiding for the entirety of 2022, which is a bit worrisome. But then if you place 2022 in its correct context, which is really a year of really high raw material prices, and Atkore management clearly explaining to us that they aren't expecting these raw material prices to remain elevated forever, well, then this guidance starts to make sense. Next up, share buybacks. The company is actually buying back their own shares at a mind-boggling pace, with about $136 million already spent during the third quarter of 2022 and a total of $500 million spent throughout the entirety of 2022. Quick reminder for anyone who doesn't know, when a company actually repurchases shares from the open market, they decrease the amount of shares outstanding. So back in 2017, the amount you owned of the business percentage-wise had to be divided by 67 million shares. And today that figure is just 44 million shares instead. That is a decrease of 34% on the shares outstanding, or a 34% increase of the piece you own of the business if you were a shareholder during this period. We'll talk more about share buybacks during the valuation part of this video, so if you didn't fully understand just yet, don't you worry, it will all be okay. So those were the two last must-knows of the company from my side. Hopefully everything is clear and has sunken in. Now I really want to show you my valuation. And really, my valuation starts with this: the company's 2023 outlook. You see, for 2023, the company is forecasting about $900 million in EBITDA, while they are forecasting about $1,300 million in EBITDA in 2022. $1,322 million in EBITDA results in EPS of around 21. So $900 million in EBITDA results in EPS in the neighborhood of $14.3 per share. So that is my starting point. $14.3 in earnings per share in 2023. Now we should really discuss growth. and I'm penciling in 12% growth in EPS for the next 5 years and 10% growth after that. You see, EPS growth can come from two main factors. After all, earnings per share equals earnings divided by total shares outstanding. So a company can increase their EPS by either first increasing their total earnings, or second, by decreasing their total shares outstanding. Number one, that increase in earnings can happen through both organic and non-organic growth, which the company is both actively pursuing, as we just saw during that company overview. And number two, decreasing the total shares outstanding, that happens when a company repurchases their own shares, which, as we have seen during the company overview, the company is also actively pursuing. Hopefully it's all come together now, but the company can increase their profitability to us shareholders by both growing their earnings and by buying back their own shares. And since the company is buying back their own shares so aggressively and growing so aggressively, I do believe that these growth rates are warranted. Honestly, they might even be conservative. Anyways, I'm using a future P ratio of 15, which is actually in line with the historic average for the S&P 500, and of course my classic discount rate of 15%, which is my desired return on investment, which is also really conservative. And well, those figures result in an intrinsic value today of around $150 per share, or about a 67% upside on the short term. But of course, I do not want to buy my shares for intrinsic value. I want to buy below intrinsic value with a healthy margin of safety of 50% in this case, which results in my heavy buy target of around $75 per share. So $75 is the mark where I am willing to go heavy. Raw dog that baby all the way up to a 30% portfolio allocation, perhaps even more. However, that doesn't mean that I am not willing to nibble in a position at slightly higher prices. Honestly, I also like the value proposition the company is currently offering at around $90 per share. So come Monday, when this video is expected to go online, I'll be buying my first couple of shares on the open market. So that was it from my side today regarding Atkore. Now, what do you think? Will you be adding a couple of shares to your portfolio after doing some research? Let me know down below in the comment section. And with that said, thank you so much for watching. I love you all. Peace.